All right, so today I want us to see how partnerships are being taxed. So taxation of partnerships. Now, the, the thing with partnerships is that partnerships are not separate legal entities. So because they are not separate legal entities, they are not taxed like companies. So any profits that accrue from a partnership are taxed on the partners themselves. So like for a company, this is a company and this is a partnership. This is a company and this is a partnership. So if a company makes net income of 100,000 and a partnership also make a net income of 100,000, they'll be taxed differently. So this is how they'll be taxed. For company, they'll be taxed, the, the company will be taxed at 30%. So this will be 30,000. Yeah, and the company will pay this amount to the government. Okay. What about when it comes to partnership? For partnership, the business will not be taxed. Instead, the partners in that business will be taxed individually. So let me say there are two partners here. You have Mina and Joroge. You have Mina and Joroge. If Mina's share of the profit in terms of their profit sharing ratio is, let me say, 1 to 1, then you'll get Mina being taxed on 50,000 because they share their profits equally. And then Joroge will also be taxed on 50,000. So this 50,000 will be on the graduated scale, like the PAYE. Yeah, so this is how partnership is taxed. And this is the difference between partnership and companies. So partnership income is taxed on individual partners because it is not a separate legal entity. All right, so let us look at some of the things that you should pay attention to when you're taxing partnerships. So there are key items for partnerships that should be taken care of. Yeah, but it is important to note that accounting profit, accounting profit, accounting profit is not always the same as tax profit. It's not always the same as tax profit. Okay. Accounting profit is not always the same as tax profit. When you get a partnership profit has made maybe 100,000, then it could be that the real income of that partnership, the real tax profit of that partnership may be less than 100,000 or even more than 100,000. So why is that the case? Now, profit is a profit comes about because of income and expenses. Yeah. So there are some incomes which are identified as accounting profits. There are some income are which qualify as trade income, so they can contribute to a situation of a profit. But there are also some incomes which are not taxable. The same way with expenses. There are some expenses which are accounting expenses, but there are some expenses which are not tax expenses. Like the example that I'm going to show you. So let me assume that for a partnership, you have you have, dividends and interest, income. So this is an example of an income which is an accounting income but not a tax income. And then expenses, also there are some expenses which are accounting expenses but not tax expenses. So let me think of an example, like for drawings, partners drawings. Yeah, partners drawings. Partners, if they draw something from the business, it may be an accounting expense, but it is not a tax expense. Tax law does not allow a business to recognize drawings as an expense. Yeah. And so what will happen is that first, the first step is that you should adjust your accounting profit in order to find the tax profit. So what you will do is that you'll get like, so adjusting accounting profit to tax profit. Accounting profit to tax profit. What do? You get accounting profit. So number one, get accounting profit. Accounting profit. And then after that, you start with incomes which are not taxable. So you less. So number two, less, you know, non-taxable income. Non-taxable incomes. Then number three, add, non-allowable expenses, non-tax allowable expenses. Like drawings, depreciation, and all those. We're going to look at those. Okay. Then then this one should give you, then you should get taxable profit or taxable net income. All right, so this is the process of getting your tax profit. Now, when you get your tax profit for a partnership, is when you now distribute this to the partners. You distribute this to the partners. All right, so let me give you an example. Let me give you an example, then we just wrap it up. Let me give you an example, then we just wrap it up. So let me say you are in a partnership of Minor and Waweru. You've been told that Minor and Waweru partnership net income or profit is equal to 100,000. But you've also been told that this 100,000 was arrived at after putting into account that it included this 100,000 included investment income, which is dividends and interest of 50,000. You've also been told that this income of 100,000 was arrived at after accounting for drawings, after accounting for partners' drawings of 20,000. And then you have been told that partners salary is 10,000 to 20,000 respectively. You've also been told that you've also been told that partners are entitled to interest on capital at 10%, and that each partner, each partner's capital is equal to 200,000. And then you have been told to find tax payable by each partner. So what will we do here? Yeah, so the first thing is to get the accounting profit. So accounting profit, then you adjust accounting profit. Accounting profit is 100,000. Add by, less income that should not be taxed here. Like dividends and interest are subjected to withholding tax as final tax. So when this partnership, maybe this partnership invested some shares in Safaricom, and then Safaricom paid this partnership 50,000 as dividends. And before Safaricom pays this partnership 50,000, Safaricom will be required to withholding tax. And thereafter, there's no other tax that should be levied on dividends and interest. So that dividend and interest should not be taxed here again, because withholding tax there was a final tax. So you will less it from 100,000 because it should not be taxed here. So less investment income of how much? 50,000. And then this expense was accounted for. This drawings was accounted for in arriving at that 100,000. But this drawings is not allowed for tax purposes, which means the tax law does not, authorize businesses to account for this as a tax expense. If you draw money from the business, then that is not a genuine business expense. So you should add it back. It should increase your tax liability because this is not a genuine business expense. So it should be added back, and anything that is added back increases your tax liability. Anything that is less reduces your tax liability. So what you'll do here, you'll add drawings back so that it starts. So you'll add back drawings of 20,000. So your tax profit now will be is it 70,000? Yeah, 100 minus 50 is 50, 50 plus 20 is 70. So this is your tax profit. This is your tax profit. Yeah. Now you have also been told that uh, after arriving at the tax profit, partners should pay each other 10,000 as salary, 10 and 20K as salary, and there should be interest on capital that we should find the tax payable. Now, there's something I did mention here, the profit sharing ratio. So let me say that find tax payable by each partner, assuming profit sharing ratio, sharing is 1 to 1. Okay. Yeah. So then after this, we're going to look at how this amount should be distributed. First, from this amount, we should account for partner salary. From this amount, interest on capital, and then the remaining one is what would be share of profit or loss. So profit is shared after partner's salary and interest on partner's capital. So that one is a point to note. Okay, so let's now do it. Now we have 70,000. Let me put this here now. 70,000. Let me start here now. You have minor and Waweru. Okay, so and total. And total. So what you'll have here is salary. Salary, you'll have 10,000 and 20,000 for Waweru. Total is 30K. So let me just put 30 because of space. Then you'll have interest on capital. So interest on capital, you have 10% and each contributed 200. So 10% of 200 is 20,000. This will be 20,000. While we also contributed 20, so 10% of 200,000 is 20,000 again. Then this one will be 40. Okay. So in this case, there's no profit that they'll share. So profit will be nil, the total will be 70. Now what each partner will be taxed on. So these are the gains. Partners are taxed on the gains that they've accrued. So this is 30, this is 40. So out of this 70,000, minor will be taxed 30,000 based on PAYE graduated rates. So not 30%. And then Waweru will be taxed on 40,000. Yes. So that is how we tax partnership. So assuming that their capital contribution was 100,000. So assume that the capital contribution was 100,000, then we would have to change this. Interest on capital now would be 10% times 100 is 10,000, and then 10% is also 10,000, and this should come up to 20,000. So we would be left with, so this plus this is 50. So then we will be left with 20,000 because the total tax profit is 70. So 70 minus 50 is 20. So if the share profit on an equal basis, then it will be each will have 10, and this one will also have 10. And as you can see, it will come up to still 30 and 40. Yeah, so but sometimes profit sharing ratio can be 1 to 2, 1 to 3, 1 to 4. Sometimes even it is a loss. So that is how you will. If it is a loss, let me say a loss of, let me say interest on capital was an amount of 60,000. Then that one they will have to share a loss here, which will reduce their taxable pay. Yeah, assuming that this, so this is just an example. Assume that the interest on capital for M was 30,000, and for Huawei was 40,000. So 30 plus 40 is 70. Okay. So what will happen here? Now in this case, you will not have profit. You will not have profit, but you will have loss. So 30 plus 70 is 100, but the tax profit is 70, which means there's a tax loss of 30,000. So this tax loss will be shared according to the profit or loss sharing ratio in the partnership agreement. So if it is 1 to 1, it means it is equal. So if the loss, like in this case, is 30 because 100 is the distribution and the profit is 70, tax profit is 70. So the loss is 30. So each will bear the loss of 15,000. This is a loss, and this is also 15,000. So in this case, minor will be minus taxable profit. So this is 30,000. Total of loss is 30,000. And then now this money will be taxed on, 40 minus 15 is 25,000. And Huawei will be taxed on, 60 minus 15 is 45,000. And this is 70 and this is 70. Yeah, it should always balance. So that's how we do taxation of partnerships. What you need to know is that accounting profit of any business is not the same as tax profit. So the best thing to do is when you're given an accounting profit, you first look at how to arrive at tax profit. You look at the incomes that are being presented, look at the expenses. Are there some incomes that should not be taxed? Are there some expenses that are not allowable? And then after adjusting for those two, you arrive at the tax profit. So when you reach the tax profit is when you distribute this tax profit according to the partnership agreement. And then each partner is taxed individually on his share of gains or losses. And then the tax rate that is used is the pay as you earn, not the corporation tax rate. So that is how we tax partnership. Thank you and God bless.